The following is a pre-recorded show. Welcome to Winning in Retirement with your host, Brian Akers, certified financial planner professional and founder of Akers Financial Group. Now, helping you win in your retirement, here's Brian Akers.
Welcome to Winning in Retirement. I'm your host, Brian Akers, certified financial planner practitioner from Akers Financial Group. Also president and founder of Akers Financial Group and the host of Winning in Retirement, a radio podcast. Here with me today, I have Mark DiOrio, Chief Investment Officer at Brookstone Capital Management. Mark has been in the industry for more than 30 years. He's been featured in Investors Business Daily and quoted in the Wall Street Journal, and known greatly by his family and friends as an all-around good guy. Mark DiOrio, we welcome you to our Akers Financial Winning in Retirement show. Good morning, Mark.
Good morning, Brian. Thanks for having me back.
Now, it's great having you back. It's great to do this show today. Today's show is here in July of 2024. It's our mid-year market review, and we look forward to hearing your words of wisdom on what has happened, and we're going to have you bring out the crystal ball towards the end of the show about what to try to think about to the future when it comes to investing.
Great.
Yeah, the cool part here is that Mark DiOrio is Chief Investment Officer at Brookstone Capital Management. When you guys are managing money, what total assets do you guys have under management currently?
Well, it's been a phenomenal run since I've been here. So I've been here 9 years at Brookstone Capital Management. When I got here, we were at $1 billion in assets under management, and today we're knocking on the door of $10 billion.
Wow. So this is all Mark DiOrio. Do you have a good team there?
Well, absolutely. It's a good team, but I think part of it has to do with understanding some of the trends that have gone on in the market over the last number of years, but also in collaboration with like-minded advisors like yourself, Brian, really figuring out how to deliver solutions to clients, such as a few years back, one of the challenges was income, for sure. There was very low interest rates, so how do you generate more income off the portfolio and so forth? And now how do you take advantage of some of the emerging trends in the marketplace? And then how you put that all together in a risk-appropriate portfolio. So I think it's about delivering solutions that work for clients.
Absolutely. Now, Brookstone has started something new, or relatively new, called Brookstone Asset Management, and that is where you are managing ETFs, exchange-traded funds. Could you tell us a little bit about that?
Correct. So about a year or so into Brookstone Asset Management, well, we decided to launch that little piece to run, because we needed a separate kind of entity to run our own homegrown exchange-traded funds, or ETFs. So a very investor-friendly investment vehicle.
Sure.
But what we decided to do was say we had a number of solutions that really resonated with the wealth management client, or the pre-retiree and retiree client. And we said, well, some of what we're looking at in the marketplace doesn't fit exactly. Maybe we should just build it to provide that solution. And so that's been off to a good start over this last year.
And official start date, was that last September of 2023?
It was, yep.
All right, and the ETFs, we're going to talk more about that later in the show. But Mark, I know you enjoy managing money. Are you still enjoying managing money?
Absolutely. I think one of the most entertaining areas, or at least what makes the job fun, is it's relevant. But as a part of that, every day you have different challenges and different opportunities that pop up in the market.
Yeah, so at Akers Financial Group, we're an independent financial services firm, and we affiliate with third-party money managers, and Brookstone is one of their main sources as a third-party money management group, because they give us many opportunities and many options for our clients in their portfolio designs and in having portfolio managers such as Mark DiOrio manage money for our clients at Akers Financial Group, and even having portfolios that are exclusive to Brookstone that we can add into the mix through a combination of core and satellite portfolios. Of course, we're going to talk more about that later, but I want to get down to the fact of the mid-year market review. We want to talk first about the state of the markets. Mark DiOrio, if you can give us a little rundown about the state of the current markets out there.
Sure. I think we can't ignore one major component of this market in particular. It started at the end of 2023 and into 2024, which is the large mega cap tech stocks have really led the market higher. In fact, the market cap weighted indexes, those are the indexes like the S&P 500, which are market cap weighted, meaning the largest companies have the largest share of that index. The top 10 companies in a 500 stock index actually represent 36% of that index. And that's a 50-year high for the level of concentration in that index. And those stocks have performed very well this year. But if you look at the equal weighted, where all 500 stocks look equal weighted, it's a mid-single digit up year. So decent, but definitely different than that concentrated portfolio. And then the other side is that bonds, part of a diversified portfolio, bonds are actually negative on the year. So there's been some caveats. We expect bonds to do a little bit better in the second half if the Federal Reserve decides to reduce interest rates. As a reminder, if interest rates decline, bond prices rise. But I think we can't ignore the structure or the state of the markets where these large cap tech stocks have really driven a lot of the performance year to date.
Right. So that's really what's been gearing is what you said was the really top 10 stocks. So those top 10 stocks, are they all tech stocks?
They're not all tech stocks. They've broken up a little bit in terms of the definition. Now, in the top 10, you'd include Berkshire Hathaway. That's Warren Buffett's company, for example. Eli Lilly is in there as well. And anymore, you see kind of a crossover with tech stocks. And, for example, Amazon, although it's a tech stock, it's also considered a consumer discretionary stock. So a lot of these larger companies are reaching into different areas and really going across segments. So some of those definitions may be a little bit more broad, where Google, for example, is also in communication services and not necessarily a specific tech stock in general, but they do kind of, in layman's terms, really catch what we're trying to say with those large cap kind of traditional tech stocks.
Right. And actually, I think you told me earlier about 3 of the stocks are actually over $3 trillion in value now.
Correct. So 2 very familiar names, probably Microsoft and Apple. And then there's a newcomer that came really out of nowhere to be the darling of the market is NVIDIA. And NVIDIA is a semiconductor company. And what that has really been driven off of is you need a lot of semiconductor processing power to fuel artificial intelligence. So AI, if you hear that theme has really gone through the market. And NVIDIA is really the poster child that's led that and has become kind of a stock market darling. And I would say that you get these kind of anomalies from different year to year where there's a standout stock. A few years back, it might have been GameStop, Peloton. So you get these names that pop up. One of the differences with NVIDIA is that it's very broad and it's impacting an entire segment, artificial intelligence, where we think that that's a multi-year theme, where a lot of other companies and stocks are going to actually ultimately benefit. And this was just an early winner at this stage. And you can see, as you mentioned, it's up to a $3 trillion market cap with Apple and Microsoft. So a very exciting time there. But we do think that there is knock-on effects. And this theme, unlike a GameStop or a Peloton, this theme of AI is going to continue and play a role overall in the broader economy.
Yeah, so AI, when it comes to NVIDIA, is there other companies that are competing with them and catching up to them?
Sure. So Taiwan Semiconductor is one of the major companies that actually makes the semiconductors, for example. And then there's a number of other semiconductor companies you'll hear. AMD is really trying to catch up, and others that are going to try to design their own chips. So this is a pretty good race. NVIDIA has just been the leader at that. I would expect historically you'd say, well, other firms catch up with their designs and so forth. But then you move down the value stack, if you will, and you see, well, now platforms will start to incorporate more AI and be able to leverage their business. And then you go into maybe enterprise applications. So those are companies that are very specific to for broad-based distribution of AI implementing in different companies. So it's a very exciting time for sure. And we've seen major R&D, research and development, as a percent of GDP being put into the marketplace. So I think corporations are really taking this serious.
Now, I know one of our things we did, you and I did a mid-year market video, and in that video you were explaining that the NVIDIA is now more valued than the UK stock market. It's 3 times the size of the Berkshire Hathaway and larger than the Russell 2000.
Correct. And that's just really part and parcel of this marketplace where you see this big tech stock really drive that return, so much so that it's bigger than an entire index of 2,000 stocks, the Russell 2000, and the UK stock market, as you mentioned, and much bigger than Berkshire Hathaway at this point. And so we've seen those run up, but we want to be mindful that that you want to maintain diversification, even though it looks very exciting in the moment.
Yeah, well, we have to remember NVIDIA was $500 billion just a year and a half ago. And so it's been a straight up run, like I almost ran up a strip of tree.
Definitely.
Yeah. So one of the things that we talk about when we talk about the market is really where it is now. And so Mark DiOrio is just giving us a little summary of what's been going on with the top 10 and the S&P. One of those key factors he mentioned was it's 36% of the value of the S&P, because the S&P is not equally weighted between each stock. It actually, through calculations, basically builds up weighting of the better performing stocks. And that's what causes this sort of imbalance between. And that's why there's other indexes out there that might equally weight. And we're definitely going to talk about that more as we continue our show. Akers Financial Group, we're designed to be local. We're independent. We don't report to a big company on Wall Street. We report to you. We do have offices in Lutherville, Farstill, clients all around the Mid-Atlantic region and some all around the country and even a few around the world. It's so easy to begin winning in retirement. Just give us a call and schedule your free meeting with one of our team of advisors by calling 833-WIN-RETIRE. That's 833-WINRETIRE. We'll give you a call on Monday to schedule your free in-person meeting. Go to AkersFinancialGroup.com or call us at 833-946-7384 to start planning for your retirement now. Inflation and interest rates going up or down? We'll talk about this when we return.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Welcome back to Winning in Retirement. I'm Brian Akers, certified financial planner, practitioner. I'm president and founder of Akers Financial Group. Here today with me is Mark DiOrio, Chief Investment Officer of Brookstone Capital Management. Brookstone Capital Management is a group out of Chicago that we use at Akers Financial Group for our clients as one of our third-party money managers. And the Chief Investment Officer, Mark DiOrio, is here today to help us talk about the mid-year market review, what's been going on and what to think about, and also trying to explain the markets in general in a really quick radio show, of course. So today, Mark DiOrio, you ready to go for your second quarter?
Yes, definitely.
Yeah, I'm glad you're so excited, Mark. Now, Mark, with over 20 years experience as an investment officer and really working managing money, the idea of inflation and interest have always been components where we had almost a 20-year lull of low interest rates or interest rates declining. In just the last couple of years, we started entering a period of interest rates jumping quickly, and then now we're at a point of inflation and taxes, and the question has to be, where are we going from here? Is it going up or down? If you want to tell us history stories, you can tell us futuristic stories, whatever you like to do, trying to answer this question of inflation and interest rates going up or down.
Well, so I'll take it from the point of the prime goal of building an investment portfolio is to preserve your purchasing power over time and grow that purchasing power over time. And what that really means is grow at a rate faster than inflation. And so inflation's always been part of building a portfolio over time. The issue with inflation is you don't necessarily see it all the time, and it can be slow and cumulative. If it's only 1% to 2%, it's really not affecting you that much until you go on into the looking back over 10 years or 20 years or so forth. And when we're building the investment portfolio, we're thinking in a long-term fashion that we want to make sure that we keep our eye on the ball. So the two challenges for an investor are inflation and volatility. So volatility is a short-term risk where the markets go up and down, zig and zag, and so forth. But inflation is the longer term risk. Volatility tends to ebb and flow and then fades over time. And then inflation, though, maintains and continues to go. So for those that start to fear volatility, they should really think about, well, we're also trying to manage for long-term inflation effects, because you could just be trading one risk for the other. And I would say inflation is the bigger risk over time. And I think we saw that, and maybe everybody's a little bit more sensitive to it now than we were for a number of years because we had very low inflation rates. But now you see out of the pandemic where inflation really jumped higher, and you see it in a lot of those major purchases, whether you go to colleges, medical care, cars, houses, and so forth, that's really front and center. So we want to be mindful of that, because you can't really predict the inflation rate from year to year, but you know it's there. Historically, it's been in that 2 to 4% range long term. We've just had it for, as you mentioned, almost 2 decades, close to that 2% range, so fairly mild. And inflation is a general rise in prices overall. What are you hearing from your clients, Brian?
When it comes to inflation rates, well, the first thing they do is complain about the food prices. And so that is like the number one thing, is how high and then will it go down? And so the retirees, it's one of the first times where, it's costing us more. It really is costing us more is what they're telling me. But the food prices have been tough. And of course, the gas prices, with that doubling over the last so many years, those have been two of the bigger hits. The surprise hits have been the cost of insurance rising on people. But inflation that bugs me the most is probably the price of Snicker bars rising so quickly. So are you an expert in Snicker inflation?
I'm not an expert, but I have a definite appreciation for inflation in the chocolate category in general.
Yeah, well, I mean, as a kid on Sunday afternoons after church, we'd go with my father, go get the News American and a little piece of candy for 1 penny or 5 cents. It actually was something like a piece of candy. Now for 5 cents, you can't find 5 cents. If you do, you probably don't want to eat it. But then if you go to the Snicker bar aisle, we're talking $2, and it's not. You start to snicker at the prices. It's a tough thing. So, but inflation to my clients is really affecting what they have left over, and the idea is that our money needs to grow and keep up with inflation. And so I try to explain for our retirees that you must have money in the stock market for us to be able to handle this purchasing power. Just like you brought up as the number one issue, you have to have money in the market, even into your retirement years, to be able to keep up with inflation. Because if you just put your money in like a CD, 5% sounds incredible when we've been earning 0, but that's not been the last 3 years of inflation.
Correct. And I'm glad you mentioned that, because a lot of advice out there actually mentions that, as you move into pre-retiree into retiree, it's sell stocks and buy bonds. Well, that's actually been very troubling kind of boilerplate advice, in the sense that, you'd be selling an appreciating asset and going into a very low-yielding asset that is now assuming much more inflation risk. And so bonds, or interest rates, as you mentioned, are try to be priced at about the level of inflation, maybe a little bit higher. But that's not necessarily been the case broadly. And so the Federal Reserve sets interest rate policy for the U.S. What they do is set, if you hear the Fed is raising or lowering interest rates, they do that. They do the short-term interest rates and try to message the rest of the market through that. And what they're looking for is, they have a dual mandate. One is to maintain stable prices. That's considered about 2% inflation. And then the other is to promote policies that encourage full employment. Rule of thumb, an unemployment rate below 5%, or in that 5% and below range. Currently we're below the 5% range on unemployment, and we're heading back towards that 3% range. So the Federal Reserve raised interest rates when we had unemployment low, but inflation was spiking. And they do that to try to slow down the economy, slow down demand, to get inflation back down. And if we have some positive readings, meaning inflation closer below 3%, into that 2% range, I think they'd be pretty happy about and encouraged to reduce interest rates.
Interest rates, the Federal Reserve, they control that rate. Could you just break down what that actually means to people? What does the Federal Reserve rate mean?
Sure. So the Federal Reserve actually uses the federal discount rate, which is the rate that banks charge each other in the overnight market. And that's normal. Banks lend out money. They have to keep a certain percent in reserves. So they lend to each other in the overnight market. But that really just sets the short-term rate and kind of messages the rest of the market. So that rate right now, they give a range between 5.25% and 5.5%. There is expectation that they'll be reducing that level to at some point this year in the second half of 2024. Now that's different. At the beginning of the year, they were actually expected to reduce interest rates by about 1.5% this year, and already start reducing interest rates. They haven't yet because they haven't gotten kind of the all clear on inflation, because if they think they reduce rates too quickly, inflation could spike back higher again. So they're very mindful of that. You did see that in the 70s where there was, they raised interest rates, inflation started to come down, then they reduced interest rates too quickly and inflation spiked back up. And so they're trying to avoid that type of situation.
Yeah, that makes sense, because the volatility, when you sort of react too quickly, you basically can put out a fire or start a fire. It's like when I think about it, it's like the Federal Reserve is trying to control some money supply and the short-term rates, and then the rest of the rates are all dictated by more market. I think it's the best way to put it.
Yeah, and one of the areas that they are concerned with, one of the areas that has kind of had these lagging effects that have kept inflation a little bit higher has, of course, been in the housing market. And so if you reduce interest rates, they may stoke, further challenges in house prices, especially for buyers, given a little bit higher interest rates right now and the prices right now. And if they lower interest rates, that may definitely keep upward pressure on prices, which they do realize is challenging for American consumers overall.
Is there a way for inflation to go down where we actually get lower prices for bananas or lower prices for our food, or is there anything that can drive that down?
For sure. And it has to do with supply chains. And so supply chains, when they come online, and this is one of the issues that happened during COVID as a great example, where we think right now inflation is largely driven by supply chain problems. And so when you have supply chain problems, if it's choked up, if supply isn't online and demand stays steady, well, prices rise. It's a typical economist kind of supply-demand curve. But as supply comes back online and demand stays steady, that can have a downward impact on prices. Now, and that's called, if you have declining prices, that's deflation. Now, they also want to maintain, the Federal Reserve also wants to be mindful that you don't necessarily want deflation, a general decline in prices, because you lend, and banks lend money based on the value of certain assets and so forth. So they don't necessarily want to decline in values. Of course, on the consumables or the commodity side, the consumer generally benefits from that, whether it's lower gas prices or, as you mentioned, lower banana prices or so forth, because then they'll have a little bit more discretionary spending.
Absolutely. So this topic of inflation and interest rates truly drive the retiree when it comes to winning in retirement. So when we talk about with our individual clients about their budgets and their expenses, when the inflation's rising, we need more and more money to be able to live off of. So one of the things that people need to do in their retirement income planning is understand their full financial fingerprint, know what their expenses are now, and have room in your retirement planning to be able to grow your income so that you can have more money later when things do cost more. 3% interest rate or inflation rate or things rising at that kind of rate will basically make your expenses double over just a 24 year period. If rates are higher than that, it doubles even faster. And it's really felt like that recently. So the idea is this: make sure that you're doing planning that affects you and helps you win throughout your retirement years. And that's what we do at Akers Financial Group. We'd love to start your retirement plan with your unique financial fingerprint, and that determines always where your money should go. It's not about us. It's going to be about you. So go ahead and give us a call at 833-WIN-RETIRE and schedule an in-person meeting with one of our team of advisors. That's 833-WIN-RETIRE. Or 833-946-7384, or visit our website at akersfinancialgroup.com. Scroll down to the bottom of our homepage and schedule a meeting right there. How does an election year affect the stock market? We'll talk about what's ahead when we return.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Indeed. Welcome back to Winning in Retirement, the Akers Financial Group radio podcast. We welcome you back to the show. We're doing today is called the Mid-Year Market Review here in July 2024. Today we have our special guest, Mark DiOrio, Chief Investment Officer from Brookstone Capital Management out of Chicago. He's a part of our group out of Brookstone Capital Management that manages the money for our clients through a third-party money management agreement. So we manage money using them and build out portfolios to deliver returns and income, everything our clients will need through portfolio design. So what happens here, Mark, is we welcome you to the second half of the show. I know that you're not the biggest Baltimore fan. You're more of a Chicago fan. And here in Baltimore, we had Chicago Cubs last night shut us out. That actually not last night. That was earlier in the week, wasn't it? That was Wednesday night. I haven't gotten over it yet. It was 4-0. Are you a Cubs fan or a Chicago White Sox fan?
Usually we say Blackhawks or Bulls.
All right, so you're more field hockey.
But usually
you're more ice hockey, not field hockey. I'm sorry, ice hockey or basketball. Well, Bulls fan. I think everyone grew up being a Bulls fan, and then it's hard being a Bulls fan still, but it's good.
For sure.
That's cool. I know we got to get back to the important question of this quarter, and that is this: how does an election year affect the stock market? We all want to know what it affects. I'd like you to cover this year and maybe into next year, what at least the next 6 months, the next 18 months might look like in an election year.
Sure. We've done a number of historical studies on this and looking at market patterns and what areas do well, what areas do poorly, and so forth under different regimes. But generally in an election year, what you get is an overall uptrending market. So that might surprise some people, even because the headlines get in there, and it can get a little bit cloudy and murky because both sides are taking kind of a little bit of an artistic interpretation of the economy, where it's hard to get good data. But the market often ignores that, interestingly enough. And any kind of negative headline or kind of development is actually pretty short-lived. So what we've seen historically is a decent first quarter, a second quarter where you have some type of correction, still in an overall uptrend. Third quarter looks like the second quarter where you have some type of correction, a little bit of fear as you get closer to the election date. And then the fourth quarter actually like the first quarter and ends near its highs or into new highs for the year. So it's actually a pretty good year, but I would say that would be our base case this year. That third quarter we should see some type of pullback into the market for unknown reasons. It could be for a variety of reasons, whether it's economic related, earnings related in the market, or a political news event or something that pops up. But I expect the market to look past it, actually. And historically, after the election, the market ends pretty strongly for the year. So the negative headlines and maybe some of the negative feelings kind of get dissipated in the marketplace. In the first year of the presidential cycle, which would be next year, for example, when we do this would be considered the fourth year of the election year. The first year is actually the second strongest of the 4-year cycle. So what we found is that the 4-year historical business cycle actually lines up pretty well anymore, really since 1950, with the presidential 4-year cycle, where the first and the third year are the strongest, followed by the fourth year is decent. Second year is usually a more challenging year. And we found that pretty consistent over time. And one of the key pieces I think that we identified was the economy definitely matters in terms of the outcome, particularly if there's going to be a change. It goes back where you might not have that big of conviction if the economy is moving along. But if you get into a recession or something like that, usually that's enough to tip the scales with a change of leadership. If it's a normal economy or just a growing economy, usually it's closer to 50-50. It could go either way, just on policies and so forth.
Right. So no prediction of the election at all. We're just trying to cover the economics and the markets and some general trends based on history. Definitely not trying to predict this year. But what I want to ask you is this hard question. I know you love using these terms, so I'm going to try to ask the question in Mark DiOrio's speech and have you explain what it means and try to answer it. So the second half of 2024 has headwinds, the headwinds that we're facing. What does that mean, and what does that really mean to the markets itself?
Well, I think we generally consider it some type of kind of influence that kind of impedes progress or kind of forward progress, if you will.
Okay.
So some of those headwinds could pop up with maybe earnings growth isn't as strong as investors thought, or maybe economic growth in general, the consumer is starting to weaken. Maybe there's some fatigue. So one of those issues is how's the consumer responding now that we're a couple years past maybe some of the stimulus that was put in consumers' pockets, and it's kind of been spent down and run out, and having that inflation component in there that's kind of taxed consumers a little bit. So we've seen consumer spending actually stay pretty resilient. The U.S. consumer is very resilient in general, and that makes up 70% of GDP, gross domestic product, or the measure of the economy. So I keep that in mind. And then also sometimes the market gets ahead of itself and may overlook potential risks from time to time and may not be priced appropriately to discount or be mindful of that risk. One of those is geopolitical risk that can pop up at any time that kind of can take the market back. Those are usually not that long lasting, I would say. Those are historically, they're about 36 trading days, so almost about 2 months in time where they kind of have the reaction and then the recovery and then back to business.
How about the U.S. debt? Is that slowing the economy or hurting the economy, or what's the effect of that?
It's an interesting topic, and I get asked it a lot because it's on a lot of investors' minds and what that means. I look at it from the debt service as a percent of GDP, which is going higher. We're spending about as much as we do on defense spending now and interest and so forth. But that is still well below where it was in the 80s and 90s. So we're definitely well off where it's been historically. And
what do you
during
mean?
that time, there was a big...
Yeah, what do you mean by that? I'm sorry. The debt service. You're talking about what do you mean?
What we're paying on the debt. So how much, so you have a lot of debt outstanding, then what are you paying to service that debt from a budget perspective on a yearly basis?
As a percentage.
So if it's $1 trillion, yeah, as a percentage of the overall economy. And so right now it's relatively reasonable. And I know that's probably maybe not familiar commentary.
Yeah.
But this is a very slow moving issue. There's always a debt issue. It's a very slow moving issue. So it's not something that all of a sudden the debt comes due. That's not how it works. It's not an individual. It's the major economy in the world that continues to issue debt, roll over debt, and continues to operate. So I would say it's a slow-moving issue. It actually has, interestingly enough, some positive benefits to the private sector, which is when the government issues debt, it's debt of the government, but then on the other side, there's a buyer of that debt, that becomes an asset. So when you buy a treasury bond, that's your asset, and you expect to get interest and then your repayment of principal. So right now, they're kicking out a lot of interest. They're paying out interest because interest rates are higher. And so that's going into consumers' pockets. There's about $6 trillion in money market accounts earning that interest. They buy treasuries, that's U.S. government debt and so forth. So that's actually been part of kind of this quiet stimulus that's also happened, which is you've had a lot of money on the sidelines that's actually earning much more money than it was just by being passively in money markets at the time. Right. Now we expect that to kind of go into the markets, but that's where I say the debt issue is not a total problem. It's very slow moving. Yeah,
I agree with you to a point. Just the fact that the debt rises continuously, it just feels like we're not addressing it. I never liked debt, so it's hard to address it anywhere. So I understand the economic part of it and how by basically inflation has driven up basically the people are making more, but they have to make more to be able to cover. So it's a vicious cycle of just resetting the numbers to a higher level. And then the percentage of the debt to all that is actually a little lower. The hardest part with all of this is there's stock markets, and then there's even the high yield market. What's your general thoughts on the high yield corporate bond market?
Well, the one thing we look at with high yield bonds, so those are below investment grade, so a little riskier, and you get a little bit more income from them, or they charge a higher interest rate, is do those companies have to go back to the market at higher interest rates and refinance their debt? And usually that can cause a problem if it's higher interest rates, because maybe those companies aren't in a position to pay that debt off. And in fact, what's happened is because we had low interest rates for so long, similar in the mortgage market, a lot of high yield companies and households refinanced at lower interest rates. So we do not have high yield companies needing to refinance. Very few, about 2% of high yield companies from now through 2025. That's very minor. So there should be very limited defaults. Okay. And that's what would cause problems in that market and maybe spillover effects. But that's not the case today.
Absolutely. So when we're talking about the election year and investing and the things that slow down the economy, we're trying to hit all those this last quarter here. When you retire, the best part of retirement is supposed to be about getting your time back, where you decide how to use it. Before retirement, your time is tied up with other commitments, mainly your job. A lot of that goes away in your retirement years. Your time is now consumed by things that you want to do. It's so easy to begin winning in retirement. You go ahead and go to our website at AkersFinancialGroup.com, scroll to the schedule a meeting section, and let us know you'd like to schedule a free consultation with one of our team of advisors. That's AkersFinancialGroup.com, or you can call us at 833-WIN-RETIRE. That's 833-WIN-RETIRE. We'll give you a call on Monday to schedule your free in-person meeting. Go to AkersFinancialGroup.com or call us at 833-946-7384 to start planning for your retirement now. Should you set it and forget it? We'll explain when we return.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Welcome back to Winning in Retirement. I'm Brian Akers, certified financial planner practitioner from Akers Financial Group. This is our show, Winning in Retirement, a radio podcast. And here today, we're covering the mid-year market review with Mark DiOrio, the Chief Investment Officer at Brookstone Capital Management. That's a company we use as a third-party money manager that we have access with our clients through Akers Financial Group. And we work and build the financial planning and the investment management through Akers Financial Group and choose and work with all the different styles at Brookstone Capital Management. Here in this fourth quarter, if you missed any of this show, you can go to our website, at akersfinancialgroup.com. But this fourth quarter is just the last bit of all the incredible information we covered with Mark DiOrio. So you're going to want to listen to what he said. If you want to, and this coming week, we're going to have our webinar with Mark DiOrio and myself on the video where Mark's actually going through the actual slides and data on things that he's covering even here today on the radio show. All right, Mark. So here in the fourth quarter, the topic I want to start with is, should you set it and forget it? So what I mean by that is, should people just invest, buy something, and then just forget about their investments? And I consider that sort of a little passive. And then there's a concept of, no, you shouldn't set it and forget it. You need to manage it. You need to be more active. What are your thoughts on this?
Well, I think a combination of the two can make sense, depending on what asset classes. So it's much more nuanced. And I do hear kind of those talking points of set it and forget it and so forth. But that doesn't make a lot of sense in a dynamic economy, dynamic market where the opportunity sets are always changing. And in fact, we have a great one developing now where we talked about it early in the show, where the market cap weighted indexes, where the largest companies were really concentrated in those indexes, are outperforming relative to the equal weighted index by as much as they were in about 1998, 1999. But right after that moment in time, the equal weight went on to outperform for 7 years, meaning you'd want to more diversify away from those areas where the market concentrated in. And so at that time, it was technology stocks. But the rest of the market, after the technology stocks kind of started to sell off after 1999, actually did pretty well, small caps and so forth. So keeping in mind diversification and really a broad opportunity set makes sense to me. In addition, you have many more investment vehicles today than you did 20 years ago and even 10 years ago. And I know we use some investment vehicles that have been around after we spent time on the due diligence side from an investment perspective that really came to market within the last 5 years that really changed the risk and return profile to the benefit of end investors. And I think that's maybe a piece that is underappreciated of how much the innovation has actually occurred in investment vehicles, in exchange-traded funds, offering something called buffered ETFs. And I know it's beyond the scope of this conversation, but if you haven't heard of those actually are delivering a very solid value proposition to clients, and we've been using them for a few years. But they're definitely worth hearing about in an overall portfolio.
Absolutely. We use those in design of portfolios of our core and satellite design. Now, the core and satellite design, could you go over that just generally from a Brookstone perspective?
Definitely. And so I think going to your point of, active and passive and that combination, we actually look at it from building a portfolio utilizing a risk-appropriate core portfolio that would cover all the traditional asset classes in the right mix that's consistent with your risk profile that we'd expect to deliver on your goals. So that you'd have large cap stocks, mid cap stocks, small cap stocks, a little bit of international, some bonds. But then you complement that core portfolio with the outcome that you desire. So maybe you want a little bit more income out of your portfolio. So you tilt in that direction with the satellite allocations. Maybe you say, well, what's the opportunities in the market today? So you could be a moderate investor, kind of a balanced investor. But one investor says, well, I want more income. So you could be a core moderate and then have income satellites that's increasing the income from the portfolio. Another moderate investor comes in and you have a moderate core portfolio, but then you add some thematic or artificial intelligence, AI kind of thematic ETFs to get a little bit more return on the upside. And so you really are talking about customizing around that core portfolio that keeps you consistent, directionally consistent with the overall markets, but then really gives you an individualized or a customized, what we'd say, competitive advantage of how you'd like your portfolio built. That's consistent, again, with your risk profile and your investor preferences.
Yeah, and so that's all about you take at Akers Financial Group. We take the financial fingerprint. We talk about the client themselves, and then we come down to the idea of how do we implement your money management? Where do we have the money that is protected or has the lower risk? And then actively managing money through a portfolio mixes and having it designed with core and satellite that adjusts by the person, having lower risk and having some protection on the downside through buffer and some other ways is a great idea. And then adding the other side of it for those that want it to really grow at another rate over time based on the risk that's out there. So I think what happens with individual management, it's great to have all these tools and be able to deliver it for our clients on an individual basis, because that's the reason Akers Financial exists, is to meet individually with people with their situation, what's going on in their life, and how does this apply to them. It's not a cookie cutter portfolio that we just do one thing at a time. We do a mix of a bunch of things. And then Mark DiOrio is that chief investment officer on many of those pieces that we add in when it comes to diversifying the portfolio mix. Now, diversification, when you were talking earlier about the S&P 500 being weighted and a lot of return coming from just the 10 stocks, is diversification going to start to work better soon as the market spreads out if the things do turn more positive over the next 12 months?
Definitely. So historically, about 50% of the companies in the S&P 500, for example, have outperformed the S&P 500 in a single year. That's about the average. It's 50-50. This year, it's as low as it's been in 25 years. Only 24% of the companies are outperforming, meaning there's a lot of companies that really haven't participated in the overall uptrend of the market, which are leaving those companies very undervalued relative to the rest of the market. And then maybe something like an interest rate reduction from the Federal Reserve or a couple of those can turn the tide for those companies. And when we look at earnings expectations, those are actually higher for the other 490 companies than the top 10 companies. So there's a couple of catalysts that can turn, and other asset classes, even when you go to small cap stocks and international stocks, well, they've lagged larger cap stocks for quite some time. But if you go back over time, the market can swing, and the opportunity set kind of swings like a pendulum. And what was great on Wall Street then kind of fades, and what was not doing as well kind of rises again as well. But all in the sense of, and when we're building a portfolio, I should say, it's all in the sense of trying to be properly diversified. And as you were mentioning, Brian, how you do it with the financial fingerprint is really talking about being disciplined yet flexible in your overall portfolio allocation design.
Absolutely. The hardest part when we do a mid-year market review, it's sort of this is what happened in the market, and then trying to talk about the future. It's really hard to say, well, this is definitely going to happen. But these disciplines of building portfolios, investing based on your purpose, is how you become successful, and your money can do its job for you based on the parameters that you establish as a family. So we take this information from advisors and money managers, and then we deliver it to the person themselves. So Mark DiOrio, this mid-year market review, in summary, the year of 2024 has started out pretty well. And is that your opinion also?
Definitely. And I think the second quarter was a little choppier. You had a little bit of a correction in there before a recovery to essentially end the quarter. And I think the second half of the year will look kind of similar, where the third quarter looks like the second quarter, where we get some type of correction, then start the recovery kind of closer to the presidential election time, or as we kind of end up that quarter. And then the fourth quarter, around that presidential election to year end, looks like the first quarter, which is a generally rising market. So overall, pretty favorable. I think bonds, I think interest rates will be reduced, and I think bonds will have a little bit of a comeback as well. So perform a little bit better than they have this first part of the year. And we may see some, as we were just talking about, some broadening of market participation, and small caps, for example, and international stocks start to do better than they have done the last several years.
Yeah, the international side, you think that's going to begin to recover soon, or generally over the next couple of years?
I do. I think that's happening right about now. The discount for international companies, because the U.S. is led by so much, is very wide leaving those companies kind of under-owned and those stock markets under-owned, under-loved, and that's sometimes where the advantage comes in. And China seems to have stabilized for the most part. I don't think China's the driver of growth, that market in particular. I think that you just needed China to have some fiscal stimulus, which they have done. They were working on monetary stimulus, but that fiscal stimulus should at least stabilize China, which was, for those that don't know, they were on a pretty bad downturn for some time. But I think the other markets are where even European markets and some of the smaller Asian Pacific markets should do pretty well here.
Yeah, well, thank you very much, Mark DiOrio, for an excellent show of going over some basics of the market, a little bit about Brookstone Capital Management, and then the thought process behind what's facing the markets and ideas, just some basic ideas on what to do. Thank you very much, Mark.
Great. Thanks, Brian.
And those that might have missed the whole show or only caught bits and pieces, you go to our website at akersfinancialgroup.com, and right there under the on the radio podcast tab, you can get a copy of this show, and you also can go to and podcast and under Winning in Retirement anytime. So we want you to win in your retirement by taking advantage of the opportunity to begin planning with us at Akers Financial Group. To schedule your free meeting with one of our team of advisors, go to our website at akersfinancialgroup.com, scroll to the schedule a meeting section, and let us know you'd like to schedule your free meeting. That's akersfinancialgroup.com, or you can call us at 833-WIN-RETIRE. That's 833-WIN-RETIRE. We'll give you a call on Monday to schedule your free in-person meeting with one of our team of advisors. Start planning for your retirement now. Go to akersfinancialgroup.com or call us at 833-946-7384. Thank you for listening. I'm Brian Akers from Akers Financial Group, and we want you to be winning in retirement.
You've been listening to Winning in Retirement with your host, Brian Akers of Akers Financial Group. Akers Financial Group offers securities through Archedios Capital, an SIPC and FINRA member firm. Advisory services are provided through Archedios Wealth. Akers Financial Group and Archedios do not share any common ownership. Neither Archedios nor Akers Financial Group provides tax or legal advice. Advice given on winning in retirement is general in nature, and one should seek further advice from their financial advisor, broker, attorney, and or tax accountant before investing. Be sure to read each prospectus carefully to understand all the risks associated with each investment. Examples and scenarios shared are meant to be for illustrative purposes only. Past performance is not indicative of future results.